All right, we're diving into a fascinating financial report from February 19th, 2026. And honestly, it's telling two completely different stories. On one hand, you've got historic, record-breaking highs. But on the other, you've got these deep structural cracks starting to appear in the global economy. So let's break down what's really going on here. So, on the surface, the picture looks absolutely euphoric. I mean, the Dow Jones just closed at a historic 49,395. By all appearances, you'd think we're in this golden era of asset growth. But that, my friends, is only half the story. Because right underneath that record-breaking surface, the report we're analyzing today points out some pretty critical fractures. And we're not talking about minor tremors here. These are deep, structural cracks that could totally reshape the entire global economy this year. Okay, so here's how we're going to unpack these cracks in the system. First, we'll look at what this report calls the Great Capital Reallocation. Then we'll dive into how that's impacting the AI sector, and trust me, it's not what you think. From there, we'll check out why the US has become a center of volatility, see what's holding back Europe and China, and discover how Korea has become this unexpected safe harbor. All of this is going to lead us to a brand new map for the end of the year. So the main idea of this entire report isn't about predicting some kind of big market crash. No, it's about something way more fundamental, a massive structural shift in where global capital is actually flowing. This isn't just money moving from one stock to another. It's a complete rethinking of what actually holds value.
The report uses this really powerful term for what's been happening, malinvestment. Think of it like a sugar rush for the economy. For about a decade, artificially cheap money fueled this crazy frenzy of investment into all these flashy sectors. Stuff built more on hype than on solid fundamentals. Well, the report argues that the sugar rush is officially over, and the market is waking up with a pretty big headache. And that headache brings us directly to the hottest topic of the last few years, artificial intelligence. The analysis here is absolutely critical if you want to understand where all that reallocated capital is headed next. Now, this right here is the critical insight. The report is not predicting an AI bubble burst, where everything just collapses like it did in the dot-com era. Instead, it's forecasting a rotation, a massive shift of money out of one part of the AI world and into another. You see, the hype phase is ending, and investors are now chasing the real underlying value. And what's really interesting here is the clear distinction this report draws. For years, all the focus was on the intangible software world, companies like Alphabet and Meta. But now, this smart money is moving to the companies building the physical, tangible world that actually makes AI possible. We're talking about the construction equipment, the fiber optics, and crucially, the massive amounts of power that AI needs to run. And this chart just quantifies that rotation beautifully. Based on some pretty sophisticated market simulations, the report puts a whopping 78% probability on physical AI infrastructure stocks outperforming the big software names by the end of 2026. This isn't just a hunch, it's a data-driven forecast of a seismic shift in the market. Okay, let's pivot over to the United States and see how this builds, because while all this capital is reallocating based on fundamentals, geopolitics is adding a major layer of uncertainty. And the report positions the U.S. as the epicenter of global risk for two key reasons. First up, you have these escalating geopolitical tensions, with the White House signaling a major decision on Iran is imminent. And second, there's this unprecedented public conflict between the administration and the Federal Reserve over its research and its independence. And that is shaking the very foundation of the U.S. financial system. This quote from Minneapolis Fed President Neil Kashkari is basically a direct warning about this institutional stress. I mean, when the government publicly questions the independence of its own central bank, it rattles the foundation of financial stability and sends this shockwave of uncertainty through global markets. And this isn't just theoretical. You can see the stress in the market indicators right here. The threat of conflict in the Middle East is pushing oil prices to their highest point in 6 months. And that institutional clash? Well, it's spooking the bond market. Treasury yields are climbing above 4.1% because investors are worried that a politically controlled central bank just won't have the credibility to fight inflation effectively. So while the US is dealing with all this high-stakes political drama, the report shows that Europe and China are kind of trapped in their own long-term structural problems, which makes them less attractive places for capital to flow right now. Europe's problems are more of a slow burn, a stagnant manufacturing sector, and just deeply pessimistic consumers. China, on the other hand, presents this really strange paradox for investors. The government's heavy-handed control is scaring away private capital,
But at the same time, it's funneling billions into state-run AI initiatives. This creates this highly unpredictable environment where growth is happening, but it's not easily accessible for outside investors.
So, amidst all of this global uncertainty, the capital shifts, the US volatility, the European stagnation, the report identifies one market that is not just surviving, but is actively thriving because of these exact conditions.
On February 19th, while most global markets were in the red, South Korea's Kospi index shot up an incredible 3.09%. The report highlights this as a powerful decoupling, which basically means Korea's market isn't just following the US anymore. It's charting its own path, based on its own unique strengths. The report points to 3 key reasons for this. First, as money pivots from AI software to hardware, it's flowing directly to the Korean companies that dominate that supply chain. Second, after a decade-long party in the US market, global investors are looking for value, and Korea offers it. And third, Korea was recently added to a major global bond index, which acts like a magnet, creating this steady, reliable flow of institutional money into the country and adding a real layer of stability. Okay, so putting all these pieces together, what does the new map of the financial world actually look like by the end of 2026? Well, the report synthesizes all these trends into a really clear set of forecasts. And here are the bottom line numbers. The S&P 500 is expected to be volatile but ultimately trade sideways, pretty much stuck in a range. The Korean Caspia, however, is forecast to break new ground and test new highs. Geopolitical risk is going to keep oil prices elevated, and as a result of all that capital flowing into Korea, its currency, the won, is projected to strengthen against the dollar. So if you take away just one thing from this entire analysis, it should be this. The era of simply riding a wave of cheap money and betting on intangible hype is officially over. The market's focus has fundamentally returned to real, physical assets that you can actually see and touch, the infrastructure of our future. And this leaves us with the critical question to ponder as we navigate the rest of 2026. Is this just a short-term reaction to all the volatility, or are we witnessing the first chapter of an entirely new economic era? The answer to that question is going to define the next decade of investing.